Okay. We all pretty comfortable with the class. It's kind of huge. Okay. I'm kind of tethered to this mic, so I'm going to try and stay pretty close over here. I'm a little bit of a pacer, so I'll do my best. Okay. What are we going to do? Today we're just going to talk roadmap, what the goal of the class is, what the big picture of what we're going to do is, how we think about it, and to some extent how we do it. Evaluation is something that's really easy to give a big picture, and then really the devil is in the details. So it's easy to talk about and hard to do. So we're going to do our best to I'm going to do my best to give you a really good overview of the class today, and then we'll start to get into the details in the next couple of weeks. Okay. So today we'll talk about what valuation is exactly, how we value something specifically. We'll talk about the method that we're going to use. The method is developed largely by McKinsey, so people call it the McKinsey method. And as I talked about on Tuesday, McKinsey & Company is the biggest and probably most prestigious consulting firm in the country, and probably the world. They're who the big companies call if they need something done. And a lot of what companies need done is financial analysis. If a company is going to introduce a new product, if a company is thinking about undertaking a merger, if the company wants to sell shares or take out a big loan, a lot of what they're interested in is the financial impact of those kinds of decisions on the firm value, right? On the firm itself. And so McKinsey & Company is basically a crack team of valuation experts. They come in and say, listen, if you release a new product, this is how we think it will affect the value of the firm. It'll be good for the firm, it'll be bad for the firm, here's the reasons why. They might come in and say, listen, we think this is a bad time for you to undertake a merger. We know that you might think that this merger has, benefits to the firm. Maybe you think it provides some value to the firm, but we think this is, based on our analysis, we think this is wrong. And it may just be that the firm is something like Warren Buffett, and they're thinking about making a large investment in something else. And they're not comfortable with they want an outside opinion on the value of undertaking that kind of decision. And so they have a lot of experience here. Again, I think this book is great if you have any interest in this kind of activity in the future. But that's what we'll be following, is something called the McKinsey method. Okay? And then throughout the class, we're going to jump from a lot of different perspectives. We are going to spend some time, and this is sort of by necessity, we will spend some time talking about what valuation looks like if you're the manager or working on the management team. We're going to spend some time talking about what it looks like if you're a shareholder outside of the firm. And if you're like not a shareholder, but maybe looking to buy into the firm. And the reason why we have to distinguish between those viewpoints is because each one of those viewpoints has a different level of information about the firm. The management team, or maybe a team of McKinsey consultants hired by the management team, is going to have full information. There's going to be things that they're going to be able to know that outside shareholders won't. Because there are things that the management team knows that they don't necessarily have to report in their financial statements. If you're a shareholder, like say you're Warren Buffett and you own 10% of the firm, then you are going to have a level of information close to full information, but there is reason to suspect that management may not report things that you still want to know. And so there are going to be times and places where we have to make assumptions about the firm's behavior or the firm's financial status that we wouldn't have to do if we were the management. Now, if you're Warren Buffett, you can probably have enough pull to actually get any of that information, but other major investors probably don't have that kind of pull. So there's a level of not quite full information. And if you're not a shareholder at all, or if you're a small shareholder, or if you're another firm that might be a competitor, and you're trying to understand the value of your competitor, you're going to have way less than full information. And that means there's going to be a lot of assumptions that you have to make about the firm. And so at at many points during our discussion, we're going to talk about the same thing like 3 times based on what level of information you have. If you have full information, you can do this. This is the perfect way. If you don't have full information, you're going to have to make some guesses. Here's the best way to make those guesses. Okay, so that's the class overview. This is our lecture overview. We're just going to talk about valuation, brief overview. We're going to talk about what valuation is. The method that we're going to cover almost entirely in this class is called discounted cash flow valuation, or DCF modeling. So we'll talk about what that is. And then in the second part of the lecture, which we probably won't get till Tuesday, we'll talk about sort of the process of a common valuation model, where the things that we want to include in our model and the things that we don't want to include in our model. So some of that might feel a little bit, especially if you don't know anything about the process, there'll be occasions in here where it feels like I'm trying to convince you to do something that you didn't know you needed to do in the first place. And that is just because this is a really widespread practice. And so if you go and get a job in analysis or in any kind of banking or any kind of corporate finance role where you're analyzing projects, you're going to run into people that are doing it the wrong way, like by definition, because there's lots of different wrong ways. Right? What I want you to be aware of is the most common and egregious wrong ways, so that at least you know, even if you can't do anything about it, at least you know when somebody's doing something wrong, and you can try to convince them to make a better option. If you're the lowest person on the totem pole, you just have to take it, right? You're not going to tell your boss that they're an idiot and they've been doing it wrong their whole life. You're just going to smile and nod and know in your head that they're an idiot and they've been doing it the wrong way. But there's not much you can do at that point, right? But you should know. Okay. So when we talk about value, when I talk about firm value, when you talk about investment value, when you talk about the value of your house or your car, what do we mean?
What's someone will pay for it?
Yeah, that's a really good reason, right? I used to collect trading cards when I was a kid, and you'd always see these reports, online or in magazines or something saying this card is worth $200, but you can never sell it for $200 because nobody really want to buy it. So yeah, I think there's a good argument to say that value is what something will pay for. What I want you to think about more deeply is what establishes value. Okay, let me give you a specific example. If you've been paying attention to the news, you saw that yesterday Apple became the first $2 trillion company. They have a value of $2 trillion. What does that mean? Can anybody afford to pay $2 trillion for Apple? Is there anybody? Maybe the US government, right? So what does it actually mean when we say Apple is worth $2 trillion? What is worth $2 trillion? What is Apple made of? What are we valuing in that company? Does the $2 trillion just come from the value of all the stores that they have and all the laptops that they haven't sold yet and their headquarters building and all their maybe factories and stuff? Is that what the $2 trillion is counting?
Is it their brand?
Well, so brand is coming into it. It's definitely be a part of it.
Is it like their logo and like the software design?
That's definitely a part of it too. Right? Put it all together. What are we valuing when we say we value a company? Yeah, so what's the whole thing? I named some physical assets. You guys named some intangible assets, right? Not physical. Brand, software, those aren't tangible, but they're valuable assets. If I value a company, am I just valuing its assets? What else is there? Where does the real value of a company come from?
The people that are there, like the CEOs and stuff.
I would say that they are definitely helping to establish value. But I don't think I would say that that's where the value comes from.
Does it come from the consumer?
Yeah, it comes from what they do, right? The value in Apple is not in its, there is definitely valuable assets there, intangible, tangible assets. All of those things have real value, but they're not worth anywhere near 200, none of those numbers are right, $2 trillion, right? That's an imaginable amount of money. It's not necessarily from the people, although the people are who's running the business, so they're definitely helping to establish that value. What we value in a company like Apple is their ability to sell everyone in the world electronics at way overpriced. Right? At huge margins. Apple has one of the highest profit margins of any company in the world. Their average profit margin is like 35%. That's huge. Right? They sell laptops that for the same price you could build one, you could build one 20 times as good. So there's brand involved in that, there's cachet, there's cool factor, there's advertising, there's great software, there's all kinds of things involved in that. But there's also just the fact that they have managed to build this following of consumers who are willing to pay a lot of money for their products. And it's not just one time, right? A lot of times when we think about Apple, we think about an ecosystem. If you have the laptop, you also have the phone and the watch and the iPad. They bring consumers into this massive ecosystem. And when we say we're going to value something, what we are valuing, if we're going to get down to the definition, the financial definition, is the future cash flows that company can generate. So the value of anything is the present value of its future cash flows. So if we bring that context back to Apple, if someone has established that Apple is worth $2 trillion, what they're saying is that the future cash flows that Apple is going to generate are worth $2 trillion. So however long Apple is going to last into the future, right? That's the ... This could go on forever. Apple could exist for the next 2,000 years or the next 20 years. We don't have a way to know that. But for however long we think Apple's going to last, we think that the present value of the cash flows they'll generate are worth $2 trillion. And that makes it far and away the most valuable company in the world. Like, there's only 3 companies that are worth more than $1 trillion, and Amazon and Microsoft are down at 1.4. Down, like that's some small number. That's still unimaginable, right? But I mean, Apple is close to twice the next 2 closest companies, and those companies are close to twice the next closest company. Facebook's worth like $700 billion. So Apple's 3 times the value of Facebook. Then you think about companies that are doing the sort of more traditional industrial stuff, like GE, which is worth like $30 billion. Or even a giant oil company like Exxon, which is worth like $250 billion. So drastically outstrips all those companies. Now, can Apple justify a valuation that high? Is it actually worth $2 trillion? Right? By the time you get out of this class, hopefully that's what you can answer. So the second thing that you have to think about when we're thinking about valuation is, how do we use a valuation? Why do I care whether Apple is worth $2 trillion or $1.5 trillion? Let's say I'm the manager. Why does it matter to me? What do you think? What's the goal of a manager? If you were the only shareholder of Apple, what would you care that Tim Cook did? Like, what would be your single main concern for Tim Cook? Stock price, because
That's their ability to raise money.
that's my money, right? If I own all the shares and the stock price goes up, then I get more wealthy. I own the company, I own the shares. If he increases the stock price, then I make money. Everybody's happy, or I'm happy, and that's all I care about, right? So we say that the manager's goal should be to maximize shareholder value. At least that's what the shareholders are going to tell the manager to do. Now, that's not the only goal of the manager, obviously. There are other goals that we could give them if we were the shareholder. There are other goals that we think they should care about. But that's the goal we can all agree on. Okay? So if the manager cares about value, it's because the manager's goal is to maximize value. So Tim Cook is seen as doing a good job if he is making Apple more valuable. What if I'm an outside investor? Why do I care? If I'm a shareholder, obviously I'm making money. That's why I care. But what if I'm not a shareholder? I'm just somebody who's interested in the company, or maybe I'm looking at potentially becoming a shareholder. What am I looking at value for?
Stability.
Yeah, well, I don't know if I would use the word stability, but I think you're on the right track. I think what you're looking for if you're an outside investor is a picture of how the firm operates. If you can see stability and value, then you can see that the firm is probably run pretty well. If you see that value jumps all over the place, or if you see that value is decreasing and increasing, right, then you get a general picture of the financial health of the firm. Because value is just the present value of the cash flows. So if value falls, that means I think the cash flows the firm generates in the future are falling. If value rises, then I think the cash flows the firm generates in the future are also rising. Right? So as an outside investor, I'm looking at value as an indication of what the firm is doing and its general financial health. That being said, and I'll say this a lot during the class, that number, $2 trillion, doesn't have a lot of true power to help us understand the firm. Right? It's a big flashing neon sign, but it doesn't tell us a whole lot about the firm on its own. Apple might be worth $2 trillion, but does that mean it's a better firm than Microsoft that's only worth $1.4 trillion? Can we say that without a doubt? That just because a firm has more value, it is a better firm or a better run firm? Okay. If I started a company tomorrow and we found the cure for cancer, right, how valuable do you think that would be? I could spend the rest of my days like scratching my butt and it would be worth trillions. Right? We wouldn't have to do anything. Value is determined by what the company can produce and what the company can generate, but that doesn't always necessarily correlate. Right? Firms can be really good firms and really well run and still not necessarily generate the same value as another firm just because of the nature of the business that they're in. Apple has such high value because it has such high margins. If you can charge 30% more than cost on all of your products, right, and that's kind of a hand-wavy thing, but if you can generate a 30% profit margin, then you can generate an enormous amount of value compared to a really excellently run grocery store. Right? The average margin in a grocery store business is like 2 to 5%. Because nobody's going to go buy their groceries at a place that charges 30% more than everybody else. The grocery store business is cutthroat. So even an incredibly run company like, say, Costco, really well established, huge brand, people love it. Everyone knows how well run the company is. They treat their employees well. They're one of the top performing grocery stores for the last 20 years. But they'll never have a value that approaches Apple because they just can't charge that much. Even if their revenues got as high as Apple, which they probably never will, but even if their revenues climb that high, because their margins are so small, their cash flows are small, and you just can't generate value from that. So value doesn't tell us everything about the company. It is an indicator. In fact, I would go so far to say in this class that value is the least important part of the process. Coming up with that number at the end of a valuation model is the least important, the least valuable to us, the least useful part of the process. the most that we get from the process is in the establishing of value, is when we start to think about how do we determine those cash flows. When I start to look through the financial statements to understand how the firm is operating. All of the steps that come up to running this model right here, that is where the true understanding of the firm comes. The number that we get with the end is mostly bullshit. It is. Because there are so many assumptions that you have to make about the future. Remember that these are future cash flows. So these are predictions. So somebody predict the next 4 years of cash flows for Apple for me. You think you get it right? I think anybody in the world will get it right. Yeah, maybe randomly, one person, right? There's going to be some people that randomly get the answer correct. Just like there's some people that can guess the number of jelly beans in a jar. Right? They didn't do anything. There's no science there. You just guess 45 and you win. So all of our predictions about value are based on the future. And as if you were in my intro class, you heard me say this a lot. You'll hear me say this even more in this class. If you try to predict the future, you will always be wrong. You'll always be wrong, and you'll always be wrong. And even if you were right, you were still wrong. You just were lucky. You were lucky to get the wrong answer instead of the wrong one. Right? So when we come up with a number like 2 trillion, it's just an estimate. We don't know. In other words, another way to think about it is Apple crossed the 1 trillion boundary in 2019 November. So 8 months ago. 8 months ago, Apple was valued for the first time at $1 trillion. Yesterday, they were valued at 2 trillion. How did they create a whole $1 trillion worth of value in 8 months? What did they do differently? Did you hear about a new Apple product? Did they cure cancer? How did that change? This is the valuation model we're going to use right here. What's the only thing that could have changed? Yeah, our prediction about the future. All of a sudden, we predict that those cash flows are twice what we did in November of last year. But how can that be right? They didn't do anything. They didn't establish anything. I didn't hear any great news about Apple changing the world. Why is Apple worth more now? It's just that people doing these models look at the numbers again and think, oh man, we totally messed up the first time. We assumed that Apple was going to make X amount of money. Now it looks like they're going to make 2X. But all those guesses are still about the future. And our guess today is no more right than our guess 8 months ago. We have some new information, sure, right? Some new, maybe some new data that might let us make a better guess. But we didn't somehow become totally prescient. Right? We're not omniscient. We don't know what the future is going to be. So again, that's what makes the value, the end result, right, the least important part. So what are some other ways that we can, or what are some common ways that we use value? Right? We're going to work, a lot of this class is just going to be sort of, it might seem kind of tedious. We're going to do these models, and these models are tedious. There are a lot of reading financial statements, then inputting the data, then running some different analyses on the data, and try to tease out what the total value of the firm is going to be, what the cash flows are going to be, how the cash flows look different from what's reported. But who else thinks that this kind of thing is valuable, right? Or maybe a better way to say it, who are the stakeholders that are going to run valuation models and then use them in practice? Well, management's going to do it. Management will do it for any major event. So we'll be talking about that a lot throughout the class, right? In other words, we don't just run a valuation model every day. It's a huge amount of work. A really good one for a complicated company like Apple might take weeks. And that's with a team. If you're doing it by yourself, it might take longer than that. And if you're not familiar with a firm and you're moving from firm to firm, you've got to start from scratch because every firm is different. So managers are going to do it when some major event is coming up in the future. If they're going to release a new product, if they want to move into a new market, if they're thinking of expanding internationally, if they're thinking about buying a firm, all of those things. But there always is going to be intention behind it, right? So that's something that always has to be in the back of your mind whenever we're talking about these things. A valuation model is done because of something or because of the firm anticipating doing something else. We really just don't run these willy-nilly. Okay? So when we're talking about valuation, we're talking about how is the firm going to change, and that's why we do evaluation, because we say, okay, the firm's going to release a new product, that's going to affect its revenue like this. So we'll say, okay, here's historical revenue. The firm releases a new product, we think historical revenue will go up by 20%. So we look at revenue. We think it's going to affect costs a little bit because maybe we need a new supply chain, so it's going to affect costs like this. Maybe the firm will move into a new tax bracket, so we got to recalculate our taxes. Maybe the firm needs to take out a loan to fund all this activity, so we got to look at our interest change and our liabilities change. How is this decision by the firm to open a new chain, release a new product, going to change my balance sheet, my income statement, my cash flow statement? Then, using all that new information, I calculate the cash flows, I run a new model. And I say, okay, look, if the firm does this, it will increase value, and that's a decision that we should undertake. We want to take any value increasing decision. Or we look at it and we say, oh man, we're totally mistaken, right? Here's a scenario where releasing this new product actually hurts the firm, it decreases value, we don't want to take it. Or maybe a pandemic happens and the firm wants to see what's going to happen as demand is decreased drastically over a pandemic, and we're going to run a whole valuation model to see and try and model out how the firm's value is going to be affected by a drastic change in consumer behavior. We also use it if we're an outside investor, right? So this is what Warren Buffett is famous for. If you've ever heard the term value investing, that's what we're talking about here. Warren Buffett is famous for looking at companies and running valuation models and trying to see whether the stock price that's currently in the market justifies the value that he thinks the firm has. And what he's looking for is firms whose stock prices are too low for the value that he sees in the firm. Because if he does that, right, then hopefully he can buy those stocks, he can buy those shares, and eventually everyone else will recognize that this firm was more valuable than they thought. The stock price will rise and he'll make a bunch of money. Right? That's what value investing is. That's the whole idea underlying it. Is you do a model like this, you try to see if the value that you come up with is different than the value that the market says. Right? So he's famous for doing it in all kinds of sort of overlooked industries. I think the most recent giant purchase of his was a whole railroad company in the U.S. And he said people were undervaluing railroads. That he thought they still had a big role to play in delivering goods, and especially if they could speed the delivery of electric railroad locomotives and things like that, that they could still have a big role to play in delivering goods across the world. This was the U.S. railroad, so in the U.S. Right? And railroad prices, value had been decreasing because of the advent of tractor trailer, semi-trucks and airplanes and shipping and things like that. Right? People thought railroads were going to go the way of the beast. So he makes a huge bet, buys a lot of stock, buys this whole railroad company. Eventually, people recognize that railroads aren't going the way of the dinosaurs. The value goes up and he makes billions of dollars. That's the goal of a value investor. Right? So those are the other kind of people that are really using this. Hedge funds, big banks, big like conglomerates like Warren Buffett. They're running these on all kinds of firms. So if you're really interested in buying a firm that has a lot of value, this is how you're doing it. Man, I've been in my house for like 6 months. I haven't talked this much. I've had 3 classes today. I haven't talked this much in 6 months probably as I have in just today. So I'm sorry if my voice is not projecting as clearly as I try. Okay, so those are the kind of people that use it, right? There are a lot of uses. This kind of thing is super, super common. The DCF cash flow model, the discounted cash flow model, is the most common way to establish value. It's run by every firm, every bank, everyone ever. There are 5 or 6 different other models that we won't cover. They're in the book. They're used in very specific cases. So occasionally I'll say, you use this model to cover this kind of company that can't be done with a DCF. For instance, banks are not valued with discounted cash flow models. They're valued with what we call equity models. Okay? And it's just because a bank is a totally different kind of firm than any other firm. Right? A bank is completely flipped. For a bank, their liabilities are deposits and their assets are loans, which is completely reverse of every other kind of firm. So banks have a hard time being valued like this, so you use a different model. There are some other special cases like that with other models. I just don't think that's worth it unless you end up in an analyst role where you're valuing that, and then you're just going to have to learn on the fly. The ideas are similar. The methodology is there. Okay? But for instance, I've had multiple students interview with Amazon. At my previous university, we had the Amazon financial modeling team come in and give a talk and do a hiring day. And they specifically mentioned DCF modeling as their tool of choice. They talked to us, and I'll use these examples as more real world examples as I can, but they talked to us about the way that they use these models and how they implement them. Right? They also talked about when DCF isn't appropriate and when a different model might be better off. And so we'll talk about that too. But the students that I had that got internships at Amazon or got jobs during that interview day, during their interview process, Amazon had them run a DCF. They sent them home with a spreadsheet for a project that they were actually working on. They gave them a week. They had to come back and give them a simple DCF on it. So if that's the kind of job you're after, this class needs to be a priority for you. If not, then just sit back and try to soak it all in, and hopefully one day you'll remember. Okay, so now that we know the model we're going to use, and this is it, I'm telling you, it's really simple. The easiest part of valuation model is the last part. You have all the cash flows. You plug them into this model. You calculate the value. Boom, you're done. Like zero work to come up with a number. Right? We're going to have a calculator do it for us. The hard part is in establishing these values. Right? So the difficult part are these 3 things. Right? First is, what's the right cash flow to use? And this is probably the most important thing. A firm is, or anything is, valued by the present value of its future cash flows. What are the future cash flows of a firm? What do you think? What numbers actually go there? Is it profit? Is it revenue? EBIT? Here's our basic income statement. Revenue, cost, depreciation, gives me earnings before interest, taxes, depreciation, amortization. Yeah? Minus interest gives me earnings before interest and taxes. Minus taxes gives me earnings. Earnings is also called profit, remember. And then earnings is dividends and retained earnings. So which one of these items is the right cash flow to use in this valuation model? Which one tells me the most about the firm's value? What?
Profit?
Okay. Which measure of profit? This one?
No, the earnings.
Just pure earnings.
Yeah.
Okay. All right, yeah, this is what we would call profit. This is what we would call operating profit. Or sometimes called net operating profit. Okay. That's the best guess. It turns out not to be right. In fact, none of the items on the income statement are the right measure of cash flow. So it's a little bit of a trick question. Profit is the closest thing that we want, but I'm going to show you some ways that profit can be really misleading. Right? That's the next slide. So here's one of the ways where very common for people to use earnings as a measure of value. But I want to demonstrate to you really clearly why earnings is not a good measure of value, because it can be easily manipulated by the firm. The right measure of value for cash flow here, the right thing to put in the cash flow is something called free cash flows, or sometimes called in the intro, cash flows from assets. And it's a function of earnings. But it's a function of it's earnings that have been that we have made sure that earnings that can't be manipulated by the management team. Okay. The other things we got to talk about are what's the appropriate R? What's the appropriate T? How long does a firm go on? What is the appropriate discount rate? And we talked about how do we use a valuation model, right? We use it in all those different ways. But again, the true value in a model like this comes from the process. We're going to learn way more about the firm from thinking about the firm than from calculating this value at the end. And then what should we not do? That's what we want to talk about now. Okay, so as an example, let's start with a really, really simple firm. So this is a firm, we'll call it Company A. They earn $100 million in after-tax profit every year. So you can see that their EBITDA, right, their earnings before interest, taxes, depreciation, and amortization is $180 million. They pay $80 million in taxes. That's their $100 million in after-tax profit. That's this, EBIT times 1 minus the tax rate. It's after-tax profit. You got $100 million. They're going to reinvest $50 million, and they're going to pay out $50 million. Right? So half and half. What are they paying out? Where does that go? Yeah. Right? So the payout rate is the dividend payout rate. This is the money returned to the firm's owners. The investment rate is retained earnings. This is the money that we keep with the expectation that we reinvest it back into the firm. So the company has their $50 million. They're going to reinvest it. And in that new investment in the following year, they expect to earn 10%. This rate, we call this rate the ROIC, return on invested capital. So that's what this is. Return on new investment is ROIC. Right? That is the return on invested capital. So that means that any money we invest, we expect a 10% return in the future. And that investment is going to generate an extra $5 million in profits, right? Which is a profit growth rate of 5%. Because we grow from $100 million in profit to $105 million, that's 5% growth, right? And then we're going to keep investing, so we're going to stay at our investment rate. So we still invest 50% of 105. And then we invest at the 5% growth rate here, and we invest again 50% of 110.3. So that's a pretty good firm with a pretty good investment strategy. We're left over, what we have left over, this is part of this is our payout rate, what we call free cash flow. The money that is available after we have paid everything, right? If we come back to our income statement, oh, it disappeared. Oh, there it is. Right? If we come back to our little income statement, free cash flow is very similar to this idea of retained earnings because it's the money after costs have been paid, depreciation has been accounted for, interest and taxes and retained earnings have all been spent. Retained earnings has been reinvested. We don't have anything left to do with this money. That's what free cash flow represents. The revenue that the firm generates that they have no further claim on. Now, some of that can be paid out to investors, right, as in the form of dividends. And if we have no other claim on it and we don't have any reason to save it, we do pay it out to investors. We return it in the form of dividends to the owners. Okay, now let's compare it to a second firm. So company B looks really similar. They also generate $100 million in profit, and they are expected to grow their profits by 5% every year. Which one of these companies is more valuable? Let's work it out. Okay, so we have company A. Why don't you want to work for me? Okay, there we go. That's weird. Come back smaller. Let's erase that. What the hell? Okay. Huh, I guess you have to click that. Okay, two companies, A and B. So their profit starts at 100 million. It grows at 5% per year. I know that the value of a company is the present value of its future cash flows. And we can think about this concept as the net present value. So the present value of anything is the future value divided by 1 plus the discount rate raised to the time period, raised to the t. How many periods in the future is it going to be? So then my second cash flow will be 1 plus the discount rate raised to the time period 2, right? T plus 1. And then my third cash flow, 110.3, will be the time period 3. or t plus 2. So let's just choose a discount rate. I'm just going to choose 10% as the discount rate because that's easy. So we'll say 100 divided by 1 plus 0.1 raised to the time period 1, 105, 1 plus 0.1 raised to the time period 2, 110.3 divided by 1 plus 0.10 raised to the time period 3. If I do my algebra correctly, I get a value of 260,556,000. I'll just write it like that. That's the value of something that's going to generate 100 million plus for the next 3 years. That's what I think it's worth today. Not quite 315 million, right? It's not the future value of those dollars. It's the value of those cash flows today. Now, based on these numbers, which one is worth more, A or B? They're the same, right? This is all the information we have. They have the same profit, so they have the same cash flows, so they should be worth the same amount. Yes?
So are you saying that number is how much the company's worth today?
Yes. Right. So this is, here you go, this is our first valuation. Super simple. It's simple because I gave you all the numbers. The hard part of valuation is coming up with these numbers, not in actually doing the calculation. Okay. So let's go back to our problem. We know a little bit more about the firm. Right? Company A reinvests 50% of its profit. Right? They have ROIC, return on new investment, of 10%. And their growth in profit because of that is 5%. Okay? So that's the firm we've been looking at. Company B only reinvests 25%. But because their return on invested capital is 20%, they still have a growth in profit of 5%. Right? So their rate of profit growth is the same, but they reinvest half of what their competitor firm does because their return on any new investment is double. Now we just calculated the value of both of these firms based on their profit, and they should be worth the same. But based on this information, do you think that's true? Why not? Which one should be worth more?
Company B.
Why?
They have higher free cash flows and they have better returns.
So your first answer is technically correct. Yes, they have higher free cash flows, and that's how we should be valued. What your second answer is getting at what I want, which is the reason why they have higher free cash flows. Right? They should be worth more, not because they have higher free cash flows, but because they have higher return. Right? Because that's what causes their free cash flows to be higher. Right? Free cash flows is the result of this being a firm that can invest their money at a better rate. Every project they take will pay out double what A takes. How could this not be a better firm? If we increased our investment rate to 50% in Company B, would they still have the same profit? Right? Let's say Company A invests 50%, reinvests 50% instead of 20, or Company B. Now they have the same investment rate. Are they going to have the same profit? Not even close. Because the 50% that they invest will earn 20, and the 50% that A invests only earns 10. So the only reason they have the same profit is because I artificially adjusted the investment rate here so that Company B invested less. So we know Company B should be more valuable. Right? What we want to know is why. How can we tease that up? Now, that being said, I want you guys to know this, but if you pay any attention to financial news, you'll know that some of the most common ways to talk about value in the financial news are earnings per share and the earnings per share growth rate. Where earnings per share is simply profit divided by the number of shares. And the earnings per share growth rate is the growth rate in profit relative to the shares itself. This is, I mean, you'll see this on every major news channel. It'll be reported in the Wall Street Journal even. Earnings per share. It's a huge focus for companies, right? And for investors. Can you see why it might not be an appropriate focus? Right, we can flip back and we can look at the earnings per share for this company. Right? Super easy. If both companies have 100 million shares outstanding, what's their earnings per share? Well, they have $100 million in profit, in earnings, and they have 100 million shares outstanding. Earnings per share is profit divided by the number of shares. So their earnings per share is $1 per share. Is that any more different than our present value that we just calculated? Is B going to have a different earnings per share? Not at all, right? So right off the bat, one of the most common measures of value that you see in the financial news doesn't really tell us anything about the value of the firm because earnings is not a good representation of the appropriate cash flow. That being said, people care about earnings per share. They talk about it all the time. If you ever listen to like every quarter, every time companies release their financial statements, they usually hold a conference call with analysts. And that'll be like the first thing that analysts ask about. Even though analysts are supposed to be the people that know that this is not a good measure, supposed to be people running the DCF models to help the rest of us buy stocks, they still are asking about earnings per share. One of the most easily manipulated things. I'll show you how easily manipulated they are. All right, let's look at another example quickly. So here's a story about Best Buy from the Wall Street Journal, or Financial Times, sorry. All right, so it says, strong product cycles in large screen televisions and mobile phones help Best Buy report first quarter same-store sales growth ahead of Wall Street forecasts. Right, so these are analysts that work at banks. They study Wall Street. They study firms like Best Buy. They run financial models like this. They try to predict how the value of these firms is going to change. So the consumer electronics chain said comparable sales, a key industry metric, rose 0.6% in the quarter, ahead of the forecast by the analysts, which forecasted a 2% drop. The Minneapolis-based company reported profits of $129 million, or 36 cents per share. There's your earnings per share. Compared with $461 million, or $1.31 per share last year. Shares of Best Buy advanced 38% in the last year and climbed 4% today. Tell me why this story makes sense. Because here's what I read. Last year, Best Buy made $461 million in profit. This year, they made a quarter of that. Despite that, shares are up 38%. And they jumped 4% only just today with the release of this information that they made a quarter of the profit that they did last year. How is that possible? Why are shares up 38% when profit is down 75%? Well, there is some good news here. Sales growth is better. Wall Street thought sales growth was going to fall. Instead, it rose. So they sold more products at their stores. How did they sell more products and have lower profit? What do you think? What's wrong with this picture? Why doesn't earnings per share, or the growth rate in earnings per share, which is a big negative number here, affect the value of the firm, right? The value determined by shareholders. Because earnings can be manipulated. We don't know why earnings were 461 million. They could have been that high because of a one-off item. Maybe Best Buy sold a big piece of assets. Maybe they sold a bunch of buildings. Or they sold off a division of the firm. We don't know that. We don't know why it's so low. Maybe it's so low because of a one-time item. Maybe they bought a big piece of assets, and so their profit is driven down. One of the things that we're never sure about with profit is the choices that management makes. Okay. Let's flip back to this. How could company A raise their after-tax operating profit without changing their return on new investment?
Could they purchase like a new building or something? Like real estate?
Well, so if they made a purchase, that would come out ahead. Right? We would have a cost before profit. So if they were buying it before profit, they'd probably go down. But one of the things that they could do is they could invest less. Right? They could lower this rate. They could lower it to, say, 25%. Is that necessarily good for the firm? Right? So if they lowered that, by the way, right, their investment, they'd have cash flow of, they'd have investment of 75 million. At 10%, they'd be making more. So they could invest less in the firm. Because they invest less in the firm, they have higher profit. Is that good for the firm? It's not clear. It's possible that maybe they're investing too much and they don't really have good opportunities. But when they do that, they do have, we shouldn't assume that firms are taking bad opportunities, although that's another way that we can mess with earnings. Another way that we can mess with earnings is taking projects that aren't really good projects for the firm. In fact, even negative net present value projects can juice earnings for a short time. Because they can raise revenue even though they have costs that outweigh the firm's, even though they have costs that outweigh the project in the long run. So, earnings can be manipulated, and we don't trust them. The reason why prices go up here is because investors react to sales growth more than they do to earnings growth. In fact, we're going to talk about how sales growth is one of the central drivers of value in the firm.